everybody. Welcome to the Trading Market Technicals morning call video for Tuesday, November the 5th. We did get another up day in the markets. Dow Jones up 23, Nasdaq up 14.5, S&P up 6, Russell up 12. Very, very quiet trading. We did sell off just ever so slightly around 9:30 going into about 11 o'clock, and then we just kind of grinded higher pretty much most of the day. Very, very subdued trading. Markets are, looks like they're waiting for non-farm payrolls and GDP numbers Thursday and Friday of this week. We also have ECB rate decision. That's also going to spark some sort of risk on or risk off in the currency markets. I am watching the currency markets closely. We do have some risk off in the euro dollar and in the Aussie dollar itself. So something that we really continue to wait and anticipate a break out of these respected ranges that we've been having in the majors in the currency market since March of 2013. It's been very, very quiet, but I do think coming shortly we may have movement again to the downside. Now, I've been a very cautious bull. We are trend traders. We do follow the trend. However, there are lots of cracks starting to appear in this rally. The only thing that would be actionable, obviously, is price telling us. But we do look at our indicators. I'm going to show that to you tonight. This just puts me at bay of taking on more risk. So we do need to continue to watch. Obviously, when we're day trading, we look for the best quality setups for the 6.5 hours that we're trading. Now, I do like the markets higher in the longer term. However, we are up at these ranges now that the markets are just about up about 17 out of 15 trading days. We've had 2 days of a very, very shallow pullback, and the markets continue to grind higher, ignoring everything that the markets are trying to tell us here. So I do think that there's going to be a tradable top, and I just mean just a tradable top coming in the coming days and weeks. Now, we are running into some time cycles as well, but let's see what happens with price. Price is what pays us, and that is the only thing that that we are going to be looking at. Indicators are just that, indicators. Price is what confirms the indicators that I'm going to show you now. But you could see here, and let's go run through the indicators here. This is the New York Stock Exchange new 52-week highs. The markets are making new highs, but stocks are not. Okay, so you're going to have a selective few, like the transportation sector, made new all-time highs again yesterday, and that is one of our leaders. That is the leader of the 5 sectors that we follow, and you could see that and I'll show that to you in the chart segment, it is making new highs, pulling up the other indexes, but stocks are not. Big, big red flag here, guys, okay? Let's take a look at the New York Stock Exchange new highs versus new lows. Again, continues to lag. This is not a good sign. It's another red flag in the markets of this rally. You have to be cautious. You have to be a cautious bull. Now, I'm not saying that the markets cannot push higher. I do believe that will probably take out the interim high right now. But once that high is made, I do think that markets will begin to sell off and at least lock in a lot of market participants, lock in some gains before we move into the Santa Claus rally. I just don't see the market momentum pushing higher all the way into the end of the year without a sort of a decent correction between now and the next 2 to 3 weeks. Okay, new highs, new lows. New lows. New York Stock Exchange new lows starting to creep up here. So new lows are being more active than the new highs. So this is another concern of mine that I'm looking at. Stocks at the 50-day moving average. We did get a sell signal. We are at these areas where the markets tend to sell off. Okay, now we're stuck here the last couple of days, but this is another reason to be cautious. Not saying that we're going to have a market crash. I'm not saying that at all. I'm not telling you to go out and short the market. What I am saying is if you are longs, definitely hedge your bets because this is something that's, to me, is unprecedented and usually ends with some sort of a market decline. Bullish percent, we did get that kiss off the 8, and now we are back up again. Okay, markets are near its highs again, probably going to push higher yet again today. But that is where you need to be concerned about after that. NYMO. McClellan oscillator stuck right in the middle here, so we could get a big move either way without being overbought and or oversold. So a lot of room to the downside, guys. A lot of room to the downside. Here is the tick. Now the tick actually we pushed lower, and now we're back above it again. So this tick here is telling us nothing wrong with any downside movement. But again, if we continue to move lower and stay below the zero line, then that would also be a concern. Okay, take a look at the VIX, guys. Now this is something that really starting to interest me. The VIX now is getting to these areas where we usually get a market bounce, as you can see here. Doesn't have to. It would be ideal if we can break below the Bollinger Bands, but not necessarily has to. But as you can see here, we are at these lows, 1250. We could push lower. We're at 1293, so 30, 40 cents. Couple of days, we can actually move high. We can actually begin to move high, which equities would begin to sell off here. So keep an eye on that. CBOE, extremely bullish. More calls are being bought than puts. I would recommend buying protection. It's well worth it. It's cheap. It's a good insurance policy. This is something that this can't go unnoticed. We're one-sided here. I would definitely be using some caution here, guys, in this market of what I showed you on these indicators. Okay, look at the CRB. Literally getting decimated as we speak. Now, the dollar actually did okay yesterday, but actually ended up selling off ever so slight. But look at the CRB index, commodity-based index, starting to sell off. It just is, to me, is a concern here. Dollar actually sold off a little bit yesterday, but had a big move off the lows. Now, if it can pull back and bull flag into the 20-day moving average and hold this area, then I think you have a bigger push to the upside, and that would weigh on stocks and commodities yet again. So let's just keep an eye on what the dollar's doing. Dollar ended up sparking up a little bit after this massive sell-off from September. Let's see if we can gain momentum again to the upside. But if you can see, it had a real big move off the lows here. So this is something, if you're trading commodities, you want to be a little cautious about. Now, speaking of that, let's go into the chart segment. I just want to show you where we are with the E-minis. 1773 is the high at 1773 and a quarter. We almost made a 161.8% retracement. I mean, the market, this is a little silly. It's actually insane for the markets to go from 1640 to 1773 in 16 trading days. And we had 2 little days of a pullback. We had 1 day here, and everything else was up. Again, this is not advocating to go out and short the market. What I am saying is risk is to the downside. I would use extreme caution here. And if you are trading the markets intraday, look for the best setups. Me personally, it's been a little difficult looking for some good quality trades. You get into a trade, the market the stock would sell off and then bounce back again. Really skitty price action here, which tells me that market participants are very nervous. Now, again, with non-farm payrolls coming out on Friday and some event risk with the ECB rate decision and GDP, I think it's going to be sort of a relatively quiet week going into non-farm payrolls. Not if the employment number comes in around 7 and let's say 0.25%, then I think risk off will be applied to the markets where tapering might be a little bit more aggressive in March, and they may come in a little bit earlier. That is the whole word, is taper. That is the new theme right now, is what the Fed is going to do. Because, again, the reason why we're at these levels is only because of the Fed. It has nothing to do with the economy. The Fed continues to pump liquidity into the markets. POMO auctions come in almost every day, and they're pumping billions of dollars into this market. And that is all you need to know if you're a trader, right? We follow what the trend is. Put your bias off to the side. But when you get to these levels that we are literally stretched and everything is up 50%, 100%, you have to take notice and you have to be careful. Believe me, there'll be plenty of days and weeks to make a lot of money. Now, again, if you're day trading, you still need to be aware of what's going on and internally what's going on with the breadth of the market, because that also, when the markets do sell off, can take you by surprise. Real quick case in point, yesterday the markets were up about 5-6 handles early on. We sold off out of nowhere, and then the markets regained control and then rallied into the end of the day. But that is something that if the markets if the bulls did not step in and buy that dip, you could be down 200 points during the day, and then everybody looking to buy the dip, and that's where That's where that fuel begins, and the stops get be elected, and then the markets begin to push lower. So that's what I'm saying. Just use extreme caution here. Real quick, let's run through the charts. Nothing really has changed. Gold, I don't see a trade here as of yet. I do like gold higher short or a capitulatory bottom here. I like the GLD, and I would just quote the gold anywhere between 1,000 to 1,100. I'd be looking to buy with both hands. Remember, gold in the longer term is in a bear market. Now, crude oil is interesting to me. I like crude oil here. We have a lot of support in this area with the USO. Same thing in crude, exactly identical chart. I do think crude as a trade, we can actually at least get a retracement rally back up to the 200-day moving average. Yesterday, it has not told me to go and look to buy crude at the moment. But if the markets can chop around here and hold this area and take out yesterday's high, then I would take a look at crude for a retracement rally. And again, it would just be a quick move back up to the 200-day and then, of course, reevaluate it. So if you're not inclined to trade that way, I would step aside. You have to be really a quick trader, and you have to understand these retracement rallies the way they work. Okay, and let's take a look at the Spiders Weekly. Just want to show you we are still hanging above this bearish rising wedge, and we're still sitting here right above it, right? We are 3 weeks now above it, so to me, this is a bullish development, obviously, but we could go either way here, guys, and obviously the next target would be this upper end of this trend line resistance. Here is the daily chart of the Spiders. I'm looking at a takeout of this 177.68. Not too much, marginally higher, maybe 178, 78 and a quarter, and then I would look for the markets to roll over. Now again, just because the markets get up to that 178, we don't look to just go out and short the market. But this pivotal low here of 175.08 really needs to be taken out before we start to get any momentum, because as we all know, and a lot of the pros know, stops. There's a lot of stops below here. Once that 178.08 on a closing base gets taken out, stops will get elected, and we'll push this market lower. Until then, I would not be advocating any type of shorts unless you're buying protection on your portfolio. Then I would be looking to buy some VIX, maybe some outdated VIX calls, and of course any type of puts in the markets in the SPYs, the Russell or the NASDAQ, very, very cheap right now with the volatility index just under 13. Okay? Take a look at the diamonds. As you can see here, we're just sitting right on the upper end of the range here. Again, a little bit of a pause, but a big move up. And this is a good sign that the markets are at the upper end of the range. Next target would really be taking out this area and then catch this upper end of this trend line from the November 2012 lows. Here is the IWMs. Now, the Russell has been relatively weak here the last 3 trading days, and that is another sign that when you have one of the leaders starting to break down and the S&P and the Dow holding the other 3 sectors, to me is not a good sign of a healthy rally, especially what I just showed you as far as the indicators. So when you have the Russell, one of the leaders, starting to break down, that to me is also a concern. I'm going to show this to you on the other chart segment. Now, the transportation sector made new all-time highs again, and that was partly due to oil breaking down. When you see oil starting to break down and lag here, that is something that would be a concern as well. But when you have oil breaking down, that fuels the transportation sector because fuel is cheap for UPS, FedEx, and all the airlines. That's why you have airlines at virtually at all-time highs right now, because oil is below $95, below 100, and that's why you have this breakdown to the breakdown in crude. So as you can see, that's really the reason why we fueled the transportation, which actually had some buoyancy in stocks. Now, if you see the transportation sector, which again is lifting the market, and you have Russell lower, and what do we have? Banks are not participating. You can't get too much higher in equities if the financials are not participating. JP Morgan, one of the key players here, obviously partly due to its lawsuit, but still not recovering here. Take a look at Goldman. Goldman, to me, I like Goldman for higher prices for a test of the 170 area. But again, just sitting here the last 6-7 days consolidating with no movement, no breakout to the upside when the markets have actually rallied, to me is a concern. And take a look at the XLF, which is the ETF. Now, if you see here, look what's happening here. We have the momentum indicator starting to roll over, stochastics and MACD. Again, not a good sign when you start putting everything together as far as all the indicators that I showed you and some key sectors not participating in rally, and only the transportation sector moving because oil is selling off. So something that is a big concern. So I just want you guys to be aware of this. And again, it may not happen, but I need to point this out. That's my job. Apple. Okay, Apple here consolidating up in a range. I would say 540 would be a target. And if you're looking to buy, take out a breakout of yesterday's high, your low would be obviously the pivot low here of 513, or if you want to give it a little bit more room, just underneath that 20-day moving average. Risk to me is a little too high. I'm staying away from Apple on this trade as well. Again, part of the technology sector starting to lose momentum. The networking sector, we had a head and shoulders pattern, we broke, and now this is a valid pattern here. Now, I do see a lot of times when the head and shoulders pattern come that we do come in and then we back test this area. So again, let's take a look at this. Watch this area here, but I do see part of the technology sector starting to break down and starting to lose a little bit of its luster. So this is something that's a concern to me. Qs, weekly chart of Qs, sitting right up here, just kind of hanging in here, upper in the range, really not doing anything wrong, but again, we are at upside resistance. So again, keep an eye on that as well. And lastly is the Qs daily chart. Now, holding at the upper end range here, which is nice, not a problem, still bullish, but you know, once you get a little bit of momentum to the downside, we could easily break lower here. So just keep that in mind, guys, as you can see. Remember, if you're day trading, trade the best setups. And if you don't see anything, cash is a position. Step aside and then wait for the best setups. Because when the markets do move, and if we are going to move, I think there's limited upside. I don't see the markets rolling right into the end of the year, into a Santa Claus rally from October 9th lows. I just don't see it. I see a lot of price starting to lag. Momentum lagging. I see a lot of key indicators and key sectors starting to break down here. Now, we could get a movement in an internal movement from money coming out of one sector going into another. That's fine. But when I see a lot of money coming into the XLY, for instance, and utilities, that's also a concern. In healthcare, these are safe haven sectors where people want to park money until they feel that there may be some sort of a movement to the downside here. So again, just keep that in mind in the overall picture, and then we will speak to you tomorrow. Have a great day, everybody, and be safe out there. I would be using your stops. Take care. Bye.